Are you still relying on fixed deposits, FDs to grow your money? With interest rate barely keeping up with inflation, your hard-earned savings might be losing value over time. But don't worry, there are better ways to grow your money without taking on excessive risk. In this video, we will explore 10 solid alternatives to FDs, each offering better returns, more flexibility, or smarter tax benefits. By the end, you will have multiple options to diversify your investments and make your money work harder for you. Ready? Let's dive in. Hi, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. Number 1, savings account in small finance banks. Did you know some small finance banks offer savings account interest rate as high as 7%? That's almost as good as an FD, but with the added benefit of liquidity. You can withdraw your money anytime. Why it's great? You get high returns without locking in your money. The catch? Interest rates can change and some banks may require a minimum balance. If you want FD-like returns but they hate the idea of locking in your funds, this is a smart option. Number 2, corporate fixed deposits. Want FD style investing but with higher returns? Corporate FDs can offer up to 9% interest, significantly more than traditional bank FDs. So why is it great? Higher returns, flexible tenure. The catch here is these aren't insured like bank FDs and there's a small risk if the company isn't financially strong. So stick to well-rated corporate FDs from trusted companies and you will earn more without taking unnecessary risk. Number 3, post office savings schemes. If safety is your top priority, post office schemes like NSC, which is National Savings Certificate, and PPF, Public Provident Fund, are excellent choices. Why it's great? Low risk, tax benefits under Section 80C. The catch is your money is locked for a fixed period and returns may not always beat inflation. Perfect for conservative investors who want government-backed safety with decent returns. Number 4, gold, the timeless inflation hedge. Gold has been a reliable store of value for centuries. But instead of keeping physical gold, you can invest in sovereign gold bonds, which is SGBs, or gold ETFs for better security and tax benefits. So why is it great? Protects against inflation, easy to liquidate. The catch here is gold doesn't provide passive income like FDs and physical gold comes with storage concerns. So gold should be a part of your portfolio, especially for long-term wealth protection. Number 5, government bonds and RBI bonds. If you love the security of FDs but want higher returns, government bonds and RBI floating rate bonds are fantastic options. Why is it great? Fully backed by the government, often higher returns than FDs. The catch here is there's a lock-in period and interest rates can fluctuate. So it's great for those who want guaranteed returns with zero risk. Number 6 is peer-to-peer P2P lending. Be the bank and earn more. So this is something P2P lending lets you lend money to borrowers directly and earn higher interest rate, often between 10 to 15%. So why is it great? High potential returns, passive income stream. The catch here is there's a small risk of borrowers defaulting and it's not as strictly regulated as banks. So higher risk, higher reward, perfect for those with a bigger risk appetite. Number 7, annuities. If you are looking for a steady income stream, annuities can provide guaranteed payouts for life or a fixed period. So why is it great? Regular, predictable income, perfect for retirees. The catch here is once invested, your money is locked in and some annuities come with high fees. A great choice for financial security in retirement, but make sure you won't need the money anytime soon. Number 8, high dividend yielding stocks. So investing in high dividend paying stocks allows you to earn regular income while your stocks grow in value over time. So why is it great? Passive income plus potential for stock appreciation. The catch here is stock prices can fluctuate and dividends aren't always guaranteed. So choose strong, stable companies with a history of consistent dividends. Number 9, FD plus equity mutual fund combo, a safe yet smart approach. So if you are new to equity investing but worried about risk, this is a perfect strategy. Step 1, keep your principal safe in an FD. Step 2, invest only the interest in an equity mutual fund. Why is this so effective? Your original money stays risk free, so you don't lose sleep over market ups and downs. The invested interest gets exposure to equities, meaning you participate in the wealth building power of the stock market without risking your base amount. And over time, even a small equity exposure can outpace inflation and generate better returns than an FD alone. So, if you want to start investing in equities but don't want to risk your hard earned money, this is one of the smartest ways to do it. Number 10, Systematic Withdrawal Plan SWP. If you invest in FDs mainly for regular income, there's a better, more tax efficient way. Instead of earning taxable FD interest, invest in a mix of debt and equity mutual funds and set up an SWP. This allows you to withdraw a fixed amount every month, just like FD interest, but with lower taxes and higher potential growth. Why this works better than an FD? More tax efficient. So, unlike FD interest, the SWP withdrawals from mutual funds are taxed at lower capital gains rate. Number 2, inflation beating return. Your money remains invested in growth assets, meaning your withdrawals don't lose value over time. Number 3, you control how much and when to withdraw. No fixed tenure like FDs. So, if you're relying on FDs for regular income, switching to SWP can significantly improve your returns and tax savings. So, the conclusion here is the final takeaway from the video is this is the smartest way to grow your wealth. So, FDs aren't bad, but they limit your potential. So, what is the final takeaway from this video? FDs aren't bad, but they limit your potential. If you truly want to beat inflation, earn passive income, and grow your wealth, you need a better strategy. Among all the alternatives we discussed, options 9 and 10 stand out as the best long-term choices. So, FD plus equity mutual fund combo, the perfect way to grow your wealth while keeping your capital safe. So, Systematic Withdrawal Plan SWP is a smarter alternative to FDs that provides regular income with better tax efficiency. If you're still unsure which strategy suits you best, we have got you covered. Click the link in the description for a free consultation with a certified financial planner to help you choose the right investment plan for your financial goals. And don't forget to like this video, subscribe to our channel and hit the bell icon so you never miss out on valuable money tips. Which alternative are you considering? Drop a comment below so we can discuss. See you in the next video with much more interesting insights. So yeah, thanks for watching.
And definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.